Okay, so I think we're going to get started. I just wanted to start off by welcoming everyone to today's webinar on the accounting for and disclosures of intangibles. My name is PK Barrett, and I am a current practice fellow at the FASB. The FASB staff has prepared a presentation that I hope you find valuable and spurs some ideas and potential research topics related to intangibles. There is a link to the materials in the chat, so you can download the PDF of the slides, and we are recording the session and it will be available for playback after we're done today. We can go to the next slide. All right, so on this slide, we have the names and contact information for all of our presenters today. Please do not hesitate to reach out if you have any questions after the webinar today. We are also taking questions during the webinar, and you should see a Q&A button at the bottom of your Zoom profile. So please do not hesitate to put questions in there, and someone is actively monitoring, and we will answer your questions either during the webinar or towards the end when we have a Q&A session. Next slide, please. So this slide just presents our overall objectives for the webinar, as well as a high-level look at some of the topics that we'll cover off on. So the objective of today's webinar is to provide a historical perspective on the U.S. accounting for intangibles, including prior and current standard-setting efforts. Also, we're going to provide an overview of stakeholder feedback received on some of the perceived challenges in this area, and to present some potential topics for further academic research. Quick look at our agenda before we dive in. So we're going to start off today by providing some information on the Emerging Financial Reporting Issues Symposium, which is the reason we're all here today. We're going to follow that up by providing a summary of historical standards issued that relate to intangible assets. After that, we will present some stakeholder feedback received on the topic, including a discussion of the 2016 and the 2021 agenda consultations. We will also discuss other historical standard setting activities that the FASB has embarked on historically that might not have been completed. Also take a look at current projects on the FASB agenda and a quick update on some international activities. Finally, we will also discuss some potential projects and alternatives, along with academic research that may help inform those projects. And at the end, we'll have some time for any questions that we did not answer during the webinar. So with that, I will hand it off to Mike to cover some details around the symposium.
All right, thank you, PK. So one of the purposes of the webinar is to introduce you to a new conference, which we have titled the Emerging Financial Reporting Issues Symposium. This is a conference jointly sponsored by the FASB and the Jukasian Accounting Research Center at the University of Chicago's Booth School of Business. And it'll be held once a year at FASB's offices in Connecticut. So in a world of lots of different academic conferences for you to attend, there are two unique aspects or objectives to this particular conference. The first one is to encourage and support relevant research for an emerging issue. So an issue that standard setters are currently working on and thinking about, and to produce research that can actually affect standard setting as it's going on live. Second purpose here that's kind of unique is that this conference will provide an opportunity for researchers to engage with standard setters and other stakeholders. I know my time at the Private Company Council that I've been on for the last several years, I've really very much enjoyed the opportunity to engage with standard setters once a quarter, and it's changed my own thinking about research and how I can have an effect on the accounting world. And I think that opportunity to blend researchers and standard setters together is going to be a really unique aspect of this conference, along with the opportunity to really engage with a topic that is not just a historical one, but one that standard setters are working on right now. So the first topic, so we'll have this once a year. We've got this slated for at least 3 years, and we'll tackle a unique topic each time. And the first one is going to be on intangible items. And this will be the topic for today's webinar, as PK just mentioned. There are a few important dates to keep in mind here. So the first one is November 17th of this year, and this will be the paper submission deadline. So if you're interested in writing a paper and getting it presented at this conference, November 17th is the date you have to keep in mind here. Registration for the symposium itself to attend will be open on December 1st, so another important date to keep in mind. And of course, the conference itself will be on April 5th, 2024, again at the FASB offices. So now I'm going to hand it over to Christine, who's going to talk about a few more specifics about topics of interest for this particular conference. Christine?
Great, thanks, Mike. And welcome, everybody. We're really pleased that you are taking some time out of your day today to be with us. And we're very excited about this new initiative that we're working on with the Jacasian Accounting Research Center. And of course, our 2024 Symposium, which will be our first one, is focused on the issue of intangible items. And we have posted the call for papers on our website. And there's a link on this slide that will take you directly to the call for papers. But just briefly, the call for papers indicates that we are seeking papers for the conference that speak to issues such as the costs and benefits of balance sheet recognition and measurement of intangible items, the relevant measurement basis or bases, and the types of measurement challenges that might arise depending on what measurement basis is employed, the costs and benefits of disaggregation of expenditures for intangible items, costs and benefits of enhanced disclosures about intangible items, the consequences of the differential financial reporting treatment that is sometimes afforded to intangible items that are acquired versus those that are internally generated. And then last but not least, the potential for unintended consequences of the financial reporting for intangible items. So just as an example, an analysis of concerns about proprietary costs when it comes to detailed disclosures about intangible items is something that we often hear concerns about expressed by companies. The papers, if you do have a paper that you think would be a good fit for the conference, the paper portal, is already open on the website. And the deadline for submission is not until November. So we're doing this webinar early, hopefully, to encourage those that are currently working in this area to continue to do that work, but also people who may not already have a paper that they're working on. If you think of something you think would be a good fit for the conference, that you will have time to get that work done and submit it by the November deadline. But as I said, the portal is open and there is a submission fee of $75 for each paper that's submitted, and you can submit that or pay that along with your submission as part of the portal. So I think there is one question that came in that I'm going to address, and then I'm going to pass this off to Cassie. And the question that came in is there any discussion of adding goodwill back to the FASB's agenda? And I would answer that as not at this time. We, as I'm sure many of you know, removed the project from the agenda that we had that we had been working on for a little while in response to feedback that we got on our agenda consultation that we undertook back in 2021. And the board just concluded that there were other projects that were just a much greater priority, particularly projects that were a greater priority for investors. And so that's part of the reason why we removed that project from the agenda. And I think we've got a pretty full plate at this point. So, there have been no discussions about putting it back on the agenda. And with that, I will turn things over to Cassie.
Hey, thanks, Christine. So we can just go to the next slide. Okay, so before we get started, I just wanted to go over a few relevant gap definitions that may be helpful as we're thinking through some of these issues. So the first one is just the gap definition for intangible assets. So these are things that are assets, so that meet the FASB's definition of an asset. And that they lack physical substance. And here we're referring to intangible assets other than goodwill. So you can see what I think is sort of interesting about the intangible assets definition is that these things are all really tied together by what they lack. So the thing that they have in common is that they have nothing in common with anything else. So that kind of naturally makes intangible assets sort of a difficult area. Then the definitions for research and development. So research is the planned search or critical investigation aimed at discovery of new knowledge with the hope that such knowledge will be useful in developing a product, a process or a technique, or in bringing about a significant improvement to an existing product. Then development is the translation of research findings into a plan or design for a new product or process, or for a significant improvement to an existing product or process, whether or not you intend to use that or to sell it. It includes the conceptual formulation, design, and testing of product alternatives, construction of prototypes, and operation of pilot plants. So when we talk about intangible assets and research and development, that's really what we have in mind here from a gap standpoint. And then we can go to the next slide as well. And then this is just a list of some examples of acquired intangibles that can be recognized as assets. So currently those are things like trademarks, internet domain names, order or production backlog, contractual customer relationships, employment contracts, mortgage servicing contracts, trade secrets, secret formulas, and recipes. So like I said, these are things that you can recognize as an asset in an acquisition, but this is, not the only things the FASB is interested in and that CARC is interested in for purposes of the conference. So, there's a whole world of potential things that may be useful to recognize as assets, whether or not you acquire them or internally develop them. So as we're kind of going through the webinar, that's just something helpful to keep in mind if you are considering a paper for the conference. Okay, now I'm going to hand it to Nathan to get into the history of accounting for intangibles.
Thank you, Cassie. Now we'll discuss the history of intangible asset standards that have been issued. The board has issued guidance on the accounting for intangible assets over its history, beginning with FASB Statement Number 2, Accounting for Research and Development Costs in 1974. FAS 2 required the immediate expensing of all research and development costs. In 1985 and 1998, the board issued FAS 86 and cleared AICPA Statement of Position 981 respectively, both regarding the accounting for costs of computer software. FAS 86 discussed the accounting for the cost of computer software to be sold, leased, or otherwise marketed. Statement 86 divided the creation of computer software into two phases. Costs incurred to establish the technological feasibility are considered research and development under Topic 730 and are charged to expense as incurred. Costs incurred after establishing technological feasibility and before the product is available for general release are capitalized. FAS 86 was essentially a targeted exception to the general requirements of FAS 2 to expense all research and development costs. FAS 86 did not address the accounting for software to be used internally, however. AICPA Statement of Position 981 provided guidance on the accounting for the cost of computer software developed or obtained for internal use. This guidance also divided the creation of internal use software into stages. Costs incurred during the preliminary project stage are expensed as incurred. Costs incurred during the application development stage are capitalized. Maintenance costs and other costs incurred during the post-implementation operation stage are also expensed as incurred. This guidance was later leveraged in subtopic 350.50 on website development costs. In 2001, the board issued FASB Statement Number 141, Business Combinations. Statement 141 superseded APB Opinion Number 16, Business Combinations, and required the recognition of intangible assets acquired in a business combination that meet the contractual, legal, or separability criterion. Also in 2001, the FASB issued Statement Number 142, Goodwill and Other Intangible Assets, in conjunction with Statement 141. Statement 142 superseded APB Opinion Number 17, Intangible Assets, and deleted ARB 43, Chapter 5, Intangible Assets. FAS 142 required identified intangible assets that were acquired individually or with a group of other assets, but not in a business combination, to be recognized and measured at cost. Costs of internally developing, maintaining, or restoring intangible assets were required to be recognized as expense when incurred. In 2007, FASB Statement 141R was issued and superseded Statement 141, originally issued in 2001. FAS 141R made several updates to the accounting for business combinations, including to require the capitalization of acquired in-process R&D assets separate from goodwill. In 2018, Accounting Standards Update number 2018-15, Intangibles, Goodwill and Other Internal Use Software, subtopic 35040, Customers Accounting for Implementation Costs Incurred in a Cloud Computing Arrangement that is a service contract was issued. This ASU aligned the capitalization of implementation costs related to cloud computing arrangements with the capitalization requirements for software that is internally developed or obtained. In addition to the broader intangible asset guidance issued that we covered previously, the board has also issued industry-specific guidance. For example, there is industry-specific guidance for the entertainment, oil and gas, airline, and financial services industries. For example, cable television entities, programming costs during the prematurity period of the system, when the system is partially under construction and partially in use, are capitalized if they do not pertain to current operations. Broadcasters account for a license agreement for program materials as a purchase of right or group of rights. All film production costs are capitalized as incurred and required to be recognized as a separate asset. In the airline industry, takeoff and landing slots issued to airlines by the U.S. Department of Transportation are accounted for as intangible assets. In the oil and gas industry, the board has clarified the balance sheet classification and disclosure exceptions for drilling and mineral rights. The board has also clarified the accounting for costs incurred to construct a tidal plant for entities in the financial services industry. So, broadly speaking, the accounting for internally developed intangibles is typically recognition as an expense unless industry-specific guidance exists. The accounting for purchased or acquired intangibles are recognized on balance sheet at historical cost or fair value, respectively. I will now pass it off to Erica to discuss the feedback the board has received from stakeholders on this topic.
Thanks, Nathan. We're now going to highlight some key stakeholder feedback that the staff and the board has received over the years. And I'll start with the two of the agenda consultations that we have recently undertaken. Going to the next slide, in 2016, the board was at a bit of a crossroads because it had recently issued several major standards and it was trying to understand what it should prioritize to work on next. Because of this, the board directed the staff to issue an invitation to comment that included 4 different topics that had been identified by several FASB advisory groups as top priorities at that time. Not surprisingly, one of the topics was intangible assets, including discussion of research and development. The other topics were distinguishing liabilities from equity, pensions, and reporting performance and cash flows. Each of these 4 chapters included a background of each topic and a discussion of various alternatives. The invitation to comment is linked on this slide if anyone is interested in reading the discussion. Moving to the next slide, the majority of respondents to the 2016 agenda consultation listed intangibles as a higher priority as compared to the other 3 topics that I mentioned. Stakeholders provided feedback that the board and the staff had heard before, including that there's no overarching framework, which results in inconsistent accounting outcomes, especially for internally generated intangibles versus purchased intangibles. Some also mentioned that this could be an area of possible convergence with the ISB. And finally, some said that information about intangible assets is missing in the financial statements. Moving to the next slide, as I mentioned, the 2016 agenda consultation included potential alternatives for the topic. The 4 alternatives that were described for intangibles are listed on this slide, and they include recognizing internally generated intangibles at cost or fair value, B, recognizing just R&D at cost or fair value, so a subset of internally generated intangibles, C, which would be additional disclosure of internally generated intangibles, and D, which was an alternative to adopt IAS 38 intangible assets into GAAP. Most respondents preferred to start with a subset of intangibles and recommended that the board pursue alternative B to require recognition of R&D on the balance sheet. In response to this feedback, the board considered 3 different approaches in tackling intangibles broadly, including consideration of recognition of all types of intangibles. A targeted approach, conversely, would have focused on internally generated intangibles that would help to improve the consistency of recognition, such as focusing on research and development or software. And finally, a disclosure-only approach would have focused on disclosures instead of recognition. At that time, the board had decided not to further pursue any approach that considered recognition of more intangibles. The reason for this, despite feedback about R&D should be recognized, is that the board thought that that time their reviews were too diverse about recognition and measurement, and that the benefits of that type of approach would not justify the cost. For example, there was no consensus among stakeholders about whether intangibles should be recognized at cost or fair value, or which ones. And additionally, the board thought that there weren't any significant and pervasive inconsistencies in accounting that would warrant a targeted approach to solve certain issues. And therefore, the board decided to keep a qualitative disclosures project on the research agenda that would be worked on as resources came available. Fast forwarding a few years, on the next slide, Rich Jones became chairman in 2020, and in understanding what topics should be priority over the next few years, he directed the staff to undertake another agenda consultation, as several projects had been completed or were wrapping up. As a result, the staff conducted extensive stakeholder feedback during the first half of 2021 to ask stakeholders a very open-ended question: what should the board work on next? This feedback shaped the content of what was included in the 2021 agenda consultation invitation and comment document, which is also linked on this slide if you're interested in reading it. This agenda consultation was a bit different than the 2016 one, as it was more open-ended and directly driven from broad and diverse stakeholder feedback. This included 4 chapters, but was bucketed by areas rather than topics, and it included several topics within those areas. The areas it focused on were disaggregation of financial reporting, emerging areas in financial reporting, reduction of unnecessary complexity in current GAAP, and improvements to FASB standard setting processes. A discussion of intangible assets was included within the emerging areas of financial reporting topic. And specifically, stakeholders were asked 2 key questions about intangibles. 1, which intangibles should be within the scope of a project if the board were to pursue a project? And 2, if that project should primarily be focused on improvements to recognition, measurement, or disclosure. And so on the next slide, the feedback that we received on intangibles from this agenda consultation was very similar to what was received in 2016. Stakeholders pointed out that there was a lack of an overarching framework, that there are inconsistencies in the accounting for internally generated versus acquired intangibles, and that differences in book value to market value are due in part to unrecognized intangibles. This feedback was considered by the board throughout the last year and has led to the inclusion of a current research project on intangibles, which PK will go in more detail in a few slides. So with that, I'll now turn over to PK to go through some additional stakeholder feedback.
Great, thanks, Erica. All right, so slide 19 just presents a high-level look at some of the results the FASB staff obtained from a relatively large investor survey that was conducted in the second half of 2021. So this survey reached a broad group of users that may not have interacted with the FASB before, and the target audience was probably less likely to be well-versed in the current intangible accounting requirements under US GAAP. And the survey focused on the information that is provided or could be provided about intangibles and whether that information is or would be beneficial in making capital allocation decisions. Additionally, the staff purposefully described the term intangibles to include items that are broader than intangible assets under GAAP, or those that would kind of meet the definition or the conceptual framework definition of an asset. So, for example, the staff listed intangibles such as human capital or relationships with customers and suppliers and reputation in the survey. Certain sections of the survey also focused on potential improvements related to recognizing additional intangibles on the balance sheet and providing additional quantitative information in the notes to the financial statements. The survey participants also had the ability to choose specific intangibles that they would want recognized or would want more information about. Those lists of intangibles are not meant to be all inclusive, but attempted to capture some of the prevalent items discussed in like previous user outreach that the staff conducted, the staff's review of academic papers, and also a review of the acquisition and intangible footnotes in public filings, 10Ks. So in general, survey participants sought greater information on intangibles. However, there were definitely very diverse views on what the possible improvements could be to the financial statements themselves. And the suggestions range from recognition and measurement solutions to just having qualitative disclosures on intangibles. Overall, and I'm jumping to the last bullet on the slide, but overall, pursuing improvements to the recognition and measurement for intangibles was the least favorite option. The majority of respondents favored improvements to disclosures, that is either quantitative or qualitative disclosures in the footnotes. So among the types of intangibles, respondents most frequently indicated that their interest is mostly focused on R&D. So they wanted greater information, qualitative and quantitative information related to research and development activities of an entity. And the quantitative information requested included historical cost, the estimated fair value, and disaggregation of costs incurred. And other information or qualitative information requested included key value drivers, description of intangibles or intangible related efforts, and the characteristics of the intangibles or ongoing projects. So the results of this survey were presented in a public board meeting held in June of 2022, which is actually the topic of our next slide. All right, so the board had a public meeting in June of 2022 to discuss research performed to date on the accounting for disclosures and of intangibles research project. Additionally, the staff also presented 3 potential paths forward during the meeting, which included discussion of a disclosure-focused approach, a recognition and measurement approach, and an approach to make targeted updates to existing GAAP. At this meeting, the board made no technical decisions, but rather provided input for future research efforts by the staff. So of the potential paths forward presented by the staff, most board members expressed interest in an approach that would result in improved and/or expanded disclosures. Further, the staff asked the board whether the staff's research on disclosure should focus on all intangibles, those that are internally generated and acquired, or if it just should focus on internally generated intangibles, and finally, if it should focus on a subset of internally generated intangibles. Certain board members expressed interest in further research on R&D, specifically related to the master glossary definition of R&D that currently exists in the FASB codification. Also, there was interest in labor-related intangibles, such as assembled workforce or other internally generated intangibles that are not typically recognized on the balance sheet. Some board members also expressed interest in targeted updates to GAAP, such as researching the impacts of having impairment reversals, while other board members expressed support for additional just general research on intangibles. So in response to this feedback, the staff has continued to monitor the intangible landscape with a particular focus on the disclosures of R&D expense. You can go to the next slide, please. All right, so the next few slides will cover off on other areas such as historical standard setting attempts by the FASB that ultimately were not completed. I'll also touch on some international activities related to intangibles and also give a brief update on current standard setting activities that are related to intangibles. Next slide, please. All right, so we're going to start off by discussing a special report that was issued by the FASB in April of 2001, which focused on business and financial reporting challenges from the new economy. So given the report is a bit dated, it is still relevant because it focused on sort of the analysis of the purported disconnect between the new economy and existing business and financial reporting practices. And by new economy, I mean an economy that's much more focused on intangible assets versus tangible assets. So a majority of the 2001 special report examines the conceptual and practical problems surrounding recognition and measurement of internally generated intangible assets. The report makes several observations and conclusions, including noting that there is no conceptual basis to recognize acquired intangible assets, but not to recognize internally generated intangible assets. The 2001 special report identified 2 key hurdles that historically have impeded the creation of accounting standards for the capitalization of costs associated with internal generation of intangible assets, which include the time gap and the correlation gap. So the time gap, I'll start with that one first. The time gap is the time lag between when R&D costs are being incurred and when those expenditures and efforts can be demonstrated to have future benefits. So that's sort of the recognition question. And the other one, the correlation gap, the correlation gap focuses more on a measurement question that the historical cost of R&D is not a reliable measure of the future economic benefit that the R&D may create. Now, the report ultimately concludes by suggesting 4 possible FASB projects that are listed on the slide for reference. I won't go through each one, but we can go to the next slide to discuss what resulted from this report. So as a result of that 2001 special report, the FASB issued a proposal for a new agenda project. It was titled Disclosure of Information about Intangible Assets Not Recognized in the Financial Statements in August of 2001. And the proposal discussed a proposed format and content of disclosures about unrecognized intangible assets. The proposed project discussed a scope of intangibles and other value drivers and proposed requiring information about intangible assets not previously captured in like management reporting systems. So it also suggested that standard setters refine the definition of an intangible asset and sort of modernize it and bring it up to modern day economies. The purpose of the proposed project was to provide investors, creditors, and other users of financial statements with additional information to assess an entity's intangible assets. The proposal suggested a project scope focused on disclosure about internally generated intangible assets that are not recognized in the statement of financial position, but would have been recognized if acquired either separately or in a business combination. So there were several comment letters received, and the comment letters received generally supported the proposal. However, preparers expressed concerns about the costs of valuing intangible assets and sharing proprietary information. So after the proposal, the board added a project to its technical agenda in January of 2002 based on the proposal and had several board meetings throughout 2002, including a roundtable meeting of valuation specialists that was held in September of 2002. Also, as part of that project, the staff conducted investor outreach, and investors in general agreed with the FASB on a need to address the reporting of information about intangible assets, and most of them supported a FASB project to solve this issue. However, ultimately, in October of 2002, the board announced its suspension of work on improving intangible asset disclosures, primarily to allow the staff at that time to finalize other high priority projects. In January of 2004, the FASB removed this inactive project from its technical agenda. Although the board at the time acknowledged the importance of the project, it decided that the nature and timing of such a project should be considered in context of its plans for convergence with international accounting standards, which was a hot topic back in the early 2000s. So I think with that, we can go to the next slide that discusses some international activities. All right, so IAS 38, which was adopted in 2001, specifies recognition criteria for capitalizing initial costs incurred to acquire or internally generate an intangible asset and subsequent costs incurred to add to, replace, a part of, or service that asset. So an entity is required to recognize an asset if the intangible is identifiable and if two criteria are met. And the two criteria are: it is probable that the expected future benefits that are attributable to the asset will flow to the entity, and also the cost of the asset can be measured reliably. So in accordance with IAS 38, internally generated intangible assets that meet the criteria are required to be recognized on the balance sheet at cost, and identifiable assets acquired in an asset acquisition are required to be recognized at the purchase price plus any directly attributable cost of preparing the asset for its intended use. Under IFRS 3, which is the business combination guidance, intangible assets acquired in a business combination are required to be recognized at fair value as of the acquisition date. Now, a key difference in IAS 38 and US GAAP is the accounting for R&D. IAS 38 makes a distinction between accounting for research costs and accounting for development costs. Expenditures incurred during the research phase should be expenses incurred, while expenditures incurred during the development phase should potentially be recognized as an intangible asset if an entity can demonstrate it meets several criteria that are listed out in IAS 38. Now, stakeholders have indicated that there is a high amount of subjectivity involved in capitalizing development phase costs under IAS 38. Stakeholders indicated that although the requirements for internally developed costs in GAAP and IFRS standards are different, the ultimate financial reporting outcomes are often similar because the threshold for recognizing development costs as an intangible asset under IFRS standards is both high and subjective. And just I'll quickly touch on the very last bullet on this slide. So similar to the 2016 and 2021 agenda consultations that Erica previously discussed, the IASB also undertakes a public consultation on its activities and its work plan every 5 years. So in March of 2021, the IASB published their request for information third agenda consultation, which is open for comments until September of 2021. And the request for information summarized frequently suggested financial reporting issues, including intangible assets. And as part of this agenda consultation in April of 2022, the IASB decided to add a project on intangible assets to its research pipeline, which would also consider a more comprehensive review of IAS 38. That we can go to the next slide. All right, so the next couple of slides discuss some current active projects on the FASB agenda that are in some ways related to intangibles and intangible assets. And these are all items that came out of the 2021 ITC. Start with digital assets. So digital assets that are not securities or that are not held by broker dealers or investment companies generally meet the definition of intangible assets and are currently accounted for under Topic 350. Stakeholders have noted that this accounting treatment may not reflect the underlying economics and that requiring or permitting recurring fair value measurements of those assets would potentially provide more decision useful information. So in May of 2022, the board added a project to its technical agenda to improve the accounting for and disclosure of certain digital assets. There is overlap between that project and intangibles research in general because conclusions reached on the accounting for digital assets could help inform the staff's efforts on other types of intangibles, particularly those with active market prices that are traded on exchanges. Also, the board currently has a technical agenda project for the accounting for and disclosure of software development costs. The objective of this project is to modernize the accounting for software costs and enhance the transparency about an entity's software costs. Existing guidance for software costs was developed in the 80s and 90s, and stakeholders have suggested a need for improvement given modern software development practices such as Agile. The scope of this project includes software for both internal and external use. Go to the next slide, please. So another intangible project on the board's agenda is the accounting for environmental credits such as carbon offsets or renewable energy certificates. Entities generally obtain environmental credits through purchases. However, some government programs grant credits to participants. In addition, some entities operate in industries that produce environmental credits, such as a power and utility that generates electricity using renewable sources. Today, there is diversity in how these credits are accounted for, including as an intangible or as inventory or as a period cost. The project is intended to improve the recognition, measurement, and disclosure requirements for those credits. With that, I'll hand it off to Mike, who will take us through the rest of the deck.
Thanks, PK. Great to be here with everyone today. So I'll take us through the last section before our Q&A session. As PK mentioned a minute ago, at June's board meeting, the staff provided the board with 3 potential alternatives for addressing intangibles. One really focused on adding disclosures or creating more disclosure requirements. Another focused on actually recognizing additional items as an intangible asset. And then one focused on targeted improvements to existing GAAP. As Mike and Christine mentioned in their opening remarks, we believe that academic research could help inform the board's decision about which of these alternatives to pursue. And then to the extent that one of these alternatives is pursued, that research would obviously help inform the board's decision-making process thereafter. So as we go through each of these alternatives, I'll highlight some of the stakeholder feedback that we received, and then some potential research topics that may assist the board in their future decision-making process. So some stakeholders, as PK mentioned, some stakeholders suggested that the board really focus on trying to improve intangible asset disclosures. And generally speaking, those stakeholders have asked for both quantitative and qualitative disclosures, largely focused on internally developed intangibles like R&D. Those requests are not limited to the current, if you will, population or list of items that are recognized as an intangible under current GAAP. It's really looking at things that are more akin to an intangible asset, but are currently expensed as incurred. So although the comments from stakeholders have been quite broad in this area, the way to think about perhaps additional quantitative disclosures would be those that help a user understand the timing and amount of expenditures that's included in operations. And then from a qualitative perspective, just those that help understand or help a user understand more of the nature of the activities conducted by the entity. So in terms of potential areas of research related to disclosure, the overarching theme for most of these is understanding what information is decision useful to investors, and importantly, how that information is decision useful is impactful to board decisions. So we're aware that there are entities that voluntarily provide additional information today, such as disaggregated qualitative and quantitative R&D disclosures, particularly in certain industries. And there are also companies who have that disclose additional information about brand management, whether that be the costs associated with it or what qualitative activities the company is doing to maintain their brands. So research that's focused on evidence about the characteristics of those disclosures, such as what level they're being provided at or what disaggregation they're being provided at or the frequency that they're being provided, and the decision usefulness of those disclosures may be helpful for future board decisions. We've also identified 2 projects that are focused on the usefulness of intangible asset information for capital allocation decisions. That can include evidence regarding existing disclosure requirements or evidence about the characteristics of disclosures that would be more useful in those capital allocation decisions. Another potential research topic would be to look at the subject a little bit more broadly than just capital allocation decisions, focusing instead on really the evidence about the information that investors need in totality for intangibles and how that information is decision useful. And then finally, we believe the board's decision-making process could benefit from research that provides evidence about the proprietary cost of disclosures about intangible items, including those that are recognized as an asset and those that are expensed as incurred. As Christine mentioned in her opening remarks, that's something that we hear a lot about the proprietary cost. So changing gears a bit here, some stakeholders have suggested that the board focus on requiring the recognition of more internally generated intangibles, not simply just disclosing items. Those stakeholders have commented that that approach would narrow any inconsistency between the accounting for acquired intangibles, which is generally at fair value, and the accounting for internally generated intangibles, which is generally expensed as incurred. That approach also would seemingly address some stakeholder requests for additional information about those internally generated intangibles. The board has previously considered recognizing more intangibles in the past, but has encountered challenges as it has gone through that process. Those challenges include just determining what the appropriate scope of the project is. What intangible items are we talking about for the actual applicable guidance? And then from there, setting an appropriate recognition threshold, so the point in time at which it's appropriate to begin to recognize an asset. And then finally, once you hit that recognition threshold, what's the appropriate measurement framework? Is it a cost basis or a fair value measure or maybe something else? So the potential research topics identified in this area are largely focused on areas where the board has historically encountered those challenges. With respect to recognition as a whole, a research project that assesses kind of whether recognizing an intangible asset results in decision useful information may be helpful for future board decisions. And that research really could consider investors' views or evidence of the decision usefulness of amounts recognized under international standards. So as PK mentioned, there is a difference between GAAP and IFRS for the accounting for research and development cost. With respect to measurement, we've identified 3 potential areas of research, although I'm sure there are plenty of others. First, future board decisions may benefit from research that analyzes whether the basis at which an intangible is recognized affects the decision usefulness of the information provided. For example, when we're talking about internally developed intangibles, is cost basis information decision useful? And if so, how? Secondly, if the board went down a path that required entities to recognize internally developed intangibles at fair value, those companies would presumably recognize a gain in a fair number of circumstances. So research that's focused on whether that gain provides decision useful information may also be helpful for the board. And then finally, on the concept of measurement, research that's focused on whether an entity's intentions affects the relevance of the measurement basis. So for example, if an entity has an intangible that they intend to use to produce products that they then sell, Does that make one measurement basis, or does that intention make one measurement basis more decision useful than another? And then to close us out on this topic, we also believe that the types of intangibles that investors find most critical for their analysis and how those investors assess the investments that entities have made or the value created may assist the board in determining the scope of a future project. So the third approach that I wanted to touch on is that some stakeholders have really just suggested that the board look at what existing gap is in this area and make some tailored improvements. Some of those stakeholders have recommended that the board address what may be perceived as inconsistent accounting. So for example, the accounting for acquired intangibles in a business combination can vary from the accounting for those acquired in an asset acquisition in certain cases. Other stakeholders have proposed other smaller scope projects that have varying objectives, such as restricting or changing what an entity recognizes as a separate intangible in a business combination, meaning what gets subsumed into goodwill versus what gets separately recognized. Other suggestions include permitting the reversal of an impairment. And then another group of stakeholders has really asked the board for industry-specific guidance that relate to intangibles that are common in their industry. And as Nathan touched on before, there are a few pockets in existing gap today where those exist. So we've identified a few potential research topics that may be relevant to this approach. As the team highlighted throughout today, the accounting for items that are generated internally is often different from the accounting for items that are acquired from third parties. So a research project that analyzes whether having the same or a different accounting model for those items affects the decision usefulness of information may be helpful for the board. A different area of potential research really relates to the stakeholders that are asking for specific industry guidance. So research focused on whether investors in specific industries need different or better financial information about intangibles, and importantly, what the benefits of that additional information would be. May also be helpful for the board. And then finally, if the board were to pursue targeted changes, just understanding if disaggregation of expenditures for certain things such as innovation or the development of human capital would be decision useful, and how that disaggregated information would influence investment and capital allocation decisions. So with that, I will hand it off to Christine for a few quick remarks before our Q&A session.
Great. Thank you very much, Mike. So before we go to our open Q&A session, which we will be closing out our time together with, I just wanted to draw to your attention a paper that was published in Accounting Horizons in 2022 entitled Perspectives on the Financial Reporting of Intangibles. This paper came about as a result of a meeting of a group of individuals that were affiliated with standard setters in Canada, Germany, Japan, the UK, and the US, and a discussion that we had about the problem of financial reporting of intangibles. And what we found interesting as we engaged in this discussion was that not only did we not have agreement around the potential solution to the problem, we didn't even have agreement about what the problem was. And of course, before you can come up with a solution, you kind of have to have an idea of what is the problem that you're trying to solve. So some of the standard setters were very concerned about the fact that the fair value or market value of an entity and the book value of the entity are quite different for companies that have a lot of off-balance sheet intangible items. And so that was really the problem that they felt needed to be solved, which would take you to a recognition and measurement type solution to the problem. And then we had discussions about, well, what are all of the issues that and the challenges that can arise with a recognition and measurement type solution. There were other members of the discussion that didn't see that was the problem, but potentially the problem was just ensuring that there was sufficient transparent information for investors to do their own assessments of the value of entities, and that perhaps more disclosure or more disaggregation of information might be the appropriate solution in that case. But then there are questions about, well, where should those disclosures be presented? Should they be audited? Should they be provided within the financial statements or outside of the financial statements in management discussion and analysis, and so forth. Along the way, we also talked about, well, where might we need additional research to help us start to address some of these questions that we have as standard setters. And so the paper was written to provide academics with kind of a bird's eye view of that discussion and the issues that came up during that discussion. And we thought that you might find that paper helpful as well, because it also raises a lot of the similar questions that Mike was just presenting. And I would like to provide a shout out to Andrew Leonard, because I saw that he is among our participants today, and he was one of the co-authors on this paper. All right, so with that, we are going to turn it over to our Q&A session. If you do have questions, please be sure to write those into the Q&A box. And I believe we have a couple of questions on the software project that Erica is going to address. So I'll turn it over to Erica.
Sure, thanks, Christine. We had two questions come in about software, so I'll take these. The first question is, when developing and then maintaining software, where is the distinction between capitalization and expensing of costs? I'll highlight slide 9, just if anyone wants to look back. Slide 9 lists out FASB Statement 86 and AICPA Statement Position 981. And these are the two current models that are in GAAP. And so GAAP still has two models, and the distinction really is between, if you have software licenses you're selling, you capitalize after you reach technological feasibility, and you expense before that, which is a fairly high threshold. And then if you have internal use software, or you're developing arrangements where you're not have a license, but you're selling software as a solution, there's 3 different stages. And the middle stage, which is the application development stage, is where you capitalize costs, and everything else is expensed. So that is where the line is drawn, and maintenance is expensed today, with enhancements being capitalized. And the other question was, excuse me, where's the FASB holding on capturing costs incurred for internal use software in an agile approach, as opposed to the more traditional waterfall approach? And in June of 2022, a project was added to the board's agenda to modernize the accounting for software costs. So the staff is currently researching, and the board is in initial deliberations of how to modernize the accounting for software costs. So stay tuned on that. And I'll pass it to PK. There was a question about the FASB's thinking about R&D capitalization and whether it's influenced by the current capitalization of R&D for tax purposes. So I'll let PK answer this one.
Yep, thanks, Erica. So great question. Currently the accounting for recognition and measurement and disclosures of intangibles is on the research agenda, with a focus, like I mentioned earlier, on R&D. And one of the things that the staff is looking at is some definitional differences between how R&D is defined under, for example, the tax code versus how it's defined in the codification, and what some of the consequences of that are. We're also taking a look at entities that might be receiving a lot of tax credits related to R&D to see how they disclose R&D efforts in their financial statements. So I'll answer this by just saying that it is part of our research efforts, and it is something that we are considering currently. We're just looking at the questions here. Oh, Christine's gonna take the next one, I think.
Yeah, I can take one of the questions. So there was a question about the type of research that we're interested in, and whether that research that we're interested in would focus primarily on impact on investors, or if we're also interested in research that considers effects on other types of stakeholders. And companies, for example, and the costs that would be imposed on companies in meeting different requirements. And so I would say that we're interested in research on all of the potential impacts of guidance. So from the benefit perspective, as well as from the cost perspective, because when we make decisions, we have to take all of that into consideration. And so there is not an overarching preference for investor or market focused research as opposed to research that focuses on different types of stakeholders. So that hopefully answers that question. I saw that there was a question on the crypto project. Is there anybody who would like to take that question?
Sure, I can take that one, Christine. So this question just wants us to talk a little bit more about the current project on accounting for crypto assets. Specifically, what are the currently acceptable accounting treatments? And whether or not the standard, let me start there and then it's a multi-pronged question, but the first part is what are the currently acceptable accounting treatments? So currently we account for crypto assets under an historical cost plus impairment model. So you are recording your crypto assets at cost and then looking for the lowest value during the period to mark them down to. But over the past several months, that's what the board has been discussing changing. And so the board decisions to date are that for crypto assets, we'll move to a fair value model. So we'll be marking those up and down. The second part of the question is whether the standard makes a distinction between self-developed crypto versus purchased crypto. And yes, that was actually at our most recent board meeting. The board decided to scope out issuers of crypto. And then the last question is whether the standard makes a distinction between different digital assets. So for example, they say Bitcoin versus other stable coins. So we don't, scope out stable coins, but we do scope out wrapped tokens. And that was another recent development at the last board meeting. So that's really the only distinction in terms of different digital assets, besides the fact that we also scope out NFTs. Okay, and then let's see who is up next for questions.
Yeah, see, I can take a question real quick.
Okay.
And so I'll just read it out loud. It's is the board still interested in how intangibles are de-recognized, that is impairment versus amortization, but intangibles are recognized on the balance sheet? And I'll keep this pretty high level, but when I was going through my remarks earlier, I did mention that the board was interested in taking a look at potential targeted improvements to the guidance. And one of the areas that we are looking into is potential reversals of impairment, which is just another way of looking at subsequent measurement of these intangibles. So given that the project is currently on the research agenda, I would say yes. The staff is still considering and doing a lot of research on all aspects of intangible accounting, recognition, measurement, and also subsequent measurement. And then we'll go back to the board at a later date. Just checking the questions here real quick. There's another question here related to intangibles. I'll just read it out loud. Whether the FASB decides to disclose or recognize different intangibles, there is a need to do some sort of purchase price allocation process to identify and measure the intangibles similar to 805. I'm curious to hear whether this process has been discussed and considered by the board. So at this point, I would say that process has not been considered by the board. At this point, we are, like I mentioned, still in the research phase and looking at various alternatives, with a somewhat of a focus more on disclosures related to R&D efforts.
PK, I noticed that there's a question. What is your perspective on comparative firm analyses as intangible value relates to market/accounting value? I'm not quite sure what that question is asking. I was wondering if maybe it's resonating with you, and if not, maybe we could ask the person asking the question to provide a bit more detail.
No, I agree with you, Christine. I think a little bit more detail might be helpful.
Okay.
There's a question that just came in about, has the board considered breaking down intangibles into smaller categories, for example, rather than addressing accounting for intangibles as a whole, considering classification based on some other criteria? And I'll take this. I think one of the things is that the board is taking that on right now. So they've taken on software right now. So because they're looking at software, some board members may look at, if this is successful, could that be applied to other intangibles? And I think that's also what the Intangibles Research Project is identifying. Is there a subset of intangibles that we could start with disclosures or recognition and measurement? So they have kind of starting with that now.
So I can take the question. It said, for those looking for a research topic, does the FASB have a list? And I'm going to take that as a broader question than just what we're discussing today. So there isn't a list of research topics or questions that we're interested in per se. But what we have been trying to do is, when there are specific areas for which we are interested in generating interest in the academic community and doing research, that's when we hold these types of webinars to provide some background on the topic, and then also to share with the audience the types of questions that we're still trying to figure out, in hopes that someone in the audience will hear one of those questions and figure out, how they might address that question in a research project. So we have done this now for this project, obviously, on intangibles, and those slides that Mike Berryman went through listed the types of questions that are on our minds. But we also did similar webinars for this on the revenue standard, the leasing standard, and the current expected credit loss standard, because all of those projects are currently in post-implementation review, and academic research on the impacts of the adoption of those standards is very important to post-implementation review. And those webinars were recorded and archived, and the slides related to them are all available on our website as well. So if you're interested in any of those three topics, you could go and check out those materials, and you might see something of interest in there. All right, any other questions that we're going to be addressing? As I was answering, I wasn't monitoring the question list. So is there anything else out there? All right, investors determine fair value according to different approaches, example, cash flows. Ratio analyses are used to accomplish this task. What do you think about comparing ratios, example, clean surplus? So I'm not sure that I'm going to do justice to your question, but I will try to simply say that when we're gathering information about measurement bases, whether they be cost or fair value, we cast a wide net. We talk to a lot of different types of investors. We often hear different views on what the most relevant measurement basis would be, depending on the type of analysis that the investors undertake. And that's what makes this job very challenging and interesting, is that we're trying to very often take all of those different perspectives and ultimately arrive at one answer. So I don't know if that addressed your question, but if any of my colleagues have other insights that they would like to add in response, be happy to open the floor to them as well. All right. Well, I'm going to invite Mike to come back on. Here we go. Mike, I think you and I have the closing comments here. So let me just thank everybody for being with us for this presentation. We hope that you found it useful. And if you think of any questions after the fact, please do not hesitate to reach out to any of us. We will we would be happy to engage with you. And we really hope that this results in some really interesting research. Mike?
Thanks, Christine. I really like to encourage people to participate and get involved and submit their papers with this. I think when Christine, you and I came up with thought about the idea of this conference, gosh, how long ago now at this point, I think the idea of connecting standard setters and academics together in a setting like this is one of these kind of unique aspects of this, and a chance for us academics to directly influence standard setting is kind of a neat thing. So, and with my interactions with you and the other board members over the last several years, I've seen that it's very valuable. So I don't think it'll go unheard here. So definitely this is a great opportunity, I think, for academics, and we look forward to seeing some great papers here. I think this is a really neat, interesting, controversial, important, huge economic topic that we start this off with. So this should be exciting.
Yeah, it's a challenging one. So please help us. We will definitely appreciate your assistance. All right. Well, with that, I think we will close things out. Thank you very much, everybody, for attending, and we wish you a great rest of your day.
Thank you.
Thank you. Bye-bye.